A storm does not destroy a building, but it only reveals which one were built on weak foundations. And real estate market work the same way. When a crisis hits, it does not create losses. In fact, it exposes how the portfolio was built. So the question now, what is a weak portfolio? Not emotionally, but structurally. It is a portfolio built on assumptions that the market will keep rising and that liquidity will be always there and demand will absorb any supply. This is exactly where you start seeing overpriced properties sold on narrative, not fundamentals. Branded residences built on car names or jewelry brands, where the brand is strong, but the asset is not. And also, in a weak portfolio, we see short-term thinking inside long-term assets. Buying to flip something that requires time to mature, and chasing trends instead of analyzing the structure. In strong markets, all of this looks like it works. Prices go up, liquidity is easy, and even weak decisions get rewarded temporarily. But when conditions change, the order of failures become clear, where liquidity-dependent owners are forced to sell, and over-leveraged investors cannot hold anymore. Oversupply locations start competing on prices, and low-quality assets lose the ability to defend its value. Poor layout that failed the basic test of livability. Assets that looked good on paper, but in the reality, they don't work. This is not about price drops. In fact, it's about pressure, where demand slows and supply continues. At the same time, liquidity tightens and the market becomes selective. And this is exactly where certain structures get exposed, such as the rental guarantees or the hype-driven off-plan or flexible payment plans that delays reality. Actually, these are not protections. In fact, they are timing tools that work as long as liquidity is flowing. But when the liquidity is tightens, they simply stop working. This is why in every cycle, such as 2008 or 2020, you will see the same pattern, where the strong asset recover and the weak asset either take years or never fully recover. Now, the real question is not, will the market go up or down? But the real question is, what happens if it doesn't go your way? In a strong portfolio, time works for you. But in a weak portfolio, time works against you. Most people focuses on price. But the reality, the price matters only 2 days. The day you enter and the day you exit. Everything in between is holding ability. Therefore, the market does not decide your outcome. In fact, your structure does. Because in real estate, you don't lose when prices drop. In fact, you lose when you lose the luxury of time. And through Archi Lens, we don't chase the market. In fact, we decode the structure and position within it.